Very special guest presenter today that I would like to introduce everybody to. And his name is Fran Lynch. So Fran tells me his Zoom camera is not cooperating, but you're going to be able to see his presentation good. But Fran's a part of Penn Mutual. His company is Strategic Lifelines LLC. I was introduced to Fran by a fellow managing partner just a few months ago, and we got into a conversation about what Fran and his firm do from a tax planning and strategy standpoint. And we dove into this conversation about the modern pension plan. And very intriguing. I asked Fran if he would to take some time to present this concept to our team. And Fran, I know you'll tell us a little bit about what you and your team do. But Fran, I'm going to turn this over to you. Thank you so much for joining us this morning. And everybody, this open dialogue. So as we go through this conversation, if there's questions that come up, I know that Fran will be happy to entertain questions as we go. So Fran, I'm going to turn it over to you. And guys, on the Zoom invite, you see a picture of Fran, so you can tell he's a pretty good looking dude.
Thanks, Dwayne.
No, it's not either.
Can you see them now, the
We
slides?
can. Yes, sir.
Got it.
Perfect.
All good.
So let me let you know right off the bat that my partner, Gene Frost, is here with me today. We've been partners for quite a while. We're both of the managing partners here at Strategic Lifeline. Say hi, Gene.
Good morning, everybody.
Good morning,
And,
Gene.
Hey,
Thank you,
Gene.
Dwayne, for giving us the opportunity to have a conversation. This is one of a multitude of different advanced tax strategies that we do apply in our practice. What we like to do is we say the modern pension plan is not your grandfather's pension plan. It's not what the 101 is. Markedly different approach to putting away more money on a pre-tax basis for the right individual today. And what we really do is we say that the plan, if designed right, reduces taxes now and maximizes after-tax retirement income. And I think that it will play itself out why we say that as we go through these slides today. Slides advancing okay? Very good. So first thing, let's just tell you a little bit about who Strategic Lifelines are. My partner Gene's been in the business over 40 years, started with Northwestern Mutual. I started back then. We've been with Mass Mutual for a while and recently with Penn Mutual. And we've gone through an evolution, obviously started doing insurance planning, then investment planning, then added benefits, and then fee-based planning, and then eventually became ERT, CPA team-based model consultant certified. And we do consulting now. Basically, we're a direct resource for accountants, financial advisors, estate planning attorneys, and other tax professionals to help their high net worth and business owner clients mitigate the impact of taxes and leverage multi-generational wealth and legacy planning through the use of the most advanced tax planning strategies available under present tax code. And the reason that if you look at our website, and I would encourage everybody to do that, it's www.strategiclifelines.com. You'll always see the IC in strategic as being highlighted, that it stands for intellectual capital. It's our intellectual capital that guides high income and high net worth individuals to create awareness of strategies that were previously unknown to them. And I do got to make a comment. I love your introduction about advocacy. And what I heard recently is the other thing is be an influencer. An influencer is somebody that gets somebody to do something they normally wouldn't do when left to their own devices. So go out there and be an advocate and be an influencer.
Love it.
We're going to talk. This is really interesting. My partner, he'll tell you a little bit about that when he jumps in. He'll interject anytime he sees fit. We do that. We play back and forth. And I'm going to let him handle the case presentation that we're going to go through at the end, and then certainly we'll take questions. But he was very fortunate that early on in his business endeavors, really got involved in pension plans and deferred comp at a very high level. Did Yale and a whole multitude of other very high-profile public companies, and I'll let him tell you a little bit about that. But before we start, I just want to say this. If you deal with successful individuals, high net worth individuals, or you deal with high income individuals, or you're working with small business owners, there's a common theme that you're going to hear all the time. What keeps these people awake at night is taxes and business expenses. And the CPAs are having trouble because a lot of them are not aware of a lot of these strategies, helping their clients, to bring these strategies to the table that can give them relief. So one of the things to encourage you to do is be an advocate. Be an advocate for those clients that your COIs cannot bring the strategies to the table to solve their problems. So what's interesting is I don't know where tax law is going to go, but I got a pretty good idea. In the last 5 years or so, we've had a markedly smaller group of individuals that, if you talk about taxes, right, estate tax, gains tax, and income tax, we've had a much higher percentage of individuals because of how high the unified credit is that have not been facing estate tax problems. They're doing their estate plan for other reasons, and we still see plenty of people that are worth 50, 100, 300, 500 million, a billion, that is still an issue. But a lot less people that we're seeing on a daily basis are being confronted with estate tax planning issues. The real big issue in the shift in focus in tax planning has really become reduction of income taxes, ways that you can reduce people's bite from income tax. And I'll tell you what, if some of these things go through that are on the Democratic docket right now, not taking sides, Republican or Democratic, but the present administration, you're also going to have a real issue with gains tax and potentially dividends. So there couldn't be a more timely conversation about helping people reduce their income taxes and also strategies that can help them mitigate gains. Now, here's the good thing before we get into today's talk. This is very timely because of all the changes with COVID and the extensions that have gotten. Normally, you could not set up a modern pension plan past December 31st, 2020 to get the deduction in 2020. I'm here to inform you that because of the changes in the law as a result of COVID, you can actually, there's still time. You have all the way up to September 15th this year, if you have a qualified client, to establish a modern qualified plan, one of the few things that you have left to do, and still get the deduction for 2020. So as we go through this today, I want you to think about people that you could come back and either in conjunction with their CPA, their tax advisor, or your own relationship with the client, be a hero and say, hey, you know what? I might have an idea that can reduce your taxes significantly for 2020, and we're halfway through 2021 and you may not even be aware of it. So here's the concept. Many closely held business owners are looking for ways to reduce their annual income tax. As I said previously, it's the thing that keeps people up. You go have a conversation, go to a chamber meeting, you're going to hear over and over again, taxes are killing me, taxes are killing me. And I don't think it's going to get any better. And they want to accelerate the retirement savings because someday they're going to hang up the cleats, walk away from whatever it is they're doing, whether they're a high income earner, W-2 employee, or whether or not they're owning their own business, and they're going to pass it on at some point in time. And the real problem is that most conventional defined contribution plans that are available for people to fund today, such as your typical 401k and profit sharing, significantly limit the amount the business owner can contribute on a pre-tax basis based on IRS regulations. The defined benefit plan allows closely held business owners to significantly increase their ability to receive income tax benefits and accelerate tax qualified retirement savings by allowing a much larger annual contribution than can be obtained with the 401k or profit sharing, which is why you can imagine these plans have become particularly attractive for closely held business owners and other professionals. Now, one of the things we like to do right off the bat is to talk about who is a candidate. Because I got to tell you, we're involved in a lot of advanced tax planning strategies. Maybe we'll have the good possibility coming back at another time and speaking about some of the other ones that we do. But one of the things when we're talking with a lot of our CPA partners and our tax planning partners and other financial advisors is you don't have to be an expert. When we got involved with some of these strategies early on, we were just an advocate to say, hey, there's something there that you need to know about. But we needed to be able to identify who's a candidate for a conversation. So that's what I think is very important to go over. You don't have to be an expert in modern qualified pension plans. And the reality is there's 25 to 35 people on this phone. Some of you might have a lot of experience in this arena. For some of you, it could be completely new. The reality is, even if it's completely new to you, first and foremost, understand who is a candidate. You can go back and look at your book of business. You can look at your relationships and knowing that this plan his ability to be set up and get a deduction for 2020 is still in play all the way up to September 15th. And obviously, you do need a little time to get the plan in play, but most people can get it done pretty quickly. You want to ask yourself, who's a candidate? And we call this a wealth accumulation strategy for high income business owners. So the first thing is obviously those of you that are working with medical and dental professionals. Okay. Yeah, Gene brings up a good point, not hospitalists. Okay. Individual practitioners, athletes and entertainers, high income earners, independent consultants. A lot of people overlook them. Man, when you start to learn about the criteria for setting up a modern qualified plan, you realize independent consultants, some of them make a fortune and they have no employees. So you don't want to overlook them. Mortgage brokers, real estate agents, software developers, people in the construction trades. And I can go on and on and on. This is just a list of a few. Bottom line is if you have any small business owner with significant free cash flow and a low number of employees that are looking to increase their pre-tax contributions to a plan, they're a candidate for conversation. Now, it doesn't mean that the actuarial study of their business and their employees and their numbers is going to support that they're going to be able to go ahead and do this. And in fact, we usually don't proceed unless we can get at least 85 to 90% of the contributed dollars back into the plan for the owner of the business. But anyone that owns their own business with significant free cash flow and the capacity to save a significant amount of money and a low number of employees, it probably should be on your radar screen to go back and at least have a conversation.
One other comment also that gets missed. If you have any clients that serve on numerous boards, those are all independent contractors. We had a guy a few years ago, and I didn't even realize this existed as a full-time job, but he was on 7 different boards and making $500,000 a year. And we set up a pension plan and just sheltered that money on the board income. So just to kind of get your radar out there as to like who fits that profile.
So your ideal prospect, and like anything else, ideal doesn't mean it's exclusionary. Usually, obviously, once you see how a defined benefit plan works in these modern qualified plans, the older you are, the closer you are to retirement, obviously, the larger deduction. That's a major factor. But we can get significant deductions on people. We've gone down even into the upper 30s with the right dynamics in their business and got significant ability to enhance their contributions to a qualified account above and beyond what they could get into a 401k or a profit sharing plan. But in general, 45 or older should be on your radar screen, probably making at least 500 to 750,000 a year with a capacity to save a fairly significant amount of that money. Probably 10 to 15 employees or less, but we've done successful plans with up to 25 to 30 employees, depending on the actuarial study. Has a current income level that will continue for the next 3 to 5 years. The reason that we say that is this is not a strategy that's good for somebody that has a one-time income spike. That's probably a better candidate for something like a proprietary version of the charitable LLC that we use through the ideal plan. Conversation for another day. But the IRS does not look favorably on somebody that gets an income spike 1 year, sets up a defined benefit plan, and then makes a contribution and then tries to shut it down. Though there are, especially through what's happened to business owners in COVID, certainly a lot of good reasons why people might have started these plans and shut them down. But usually we're looking for a consistency of projected income for at least 3 to 5 years, and the individual looking to maximize income tax benefits and accelerate retirement income. So unlike understanding the difference between defined contribution and defined benefit plans, unlike a defined contribution plan, which is your typical 401k profit sharing, where the contribution to the plan is defined. That's why it's called a defined contribution plan. And the benefit is going to be determined by how well your investments perform and the number of years that you invest. The defined benefit plan is very unique in the sense that it allows the business owner to target a specific lump sum benefit at a later retirement date, and the annual contribution is then calculated based on an assumed rate of return. So the closer that you are to retirement and the lower the assumed rate of return, and in the DB plans, they allow to use fairly small assumptions for rate of return, the larger the contribution. So if you look at defined benefit plans, for 2020, the IRS will allow an individual to use up to $285,000 of annual compensation for the calculation. and target a lump sum benefit approaching around 3 million at retirement. The actuary will then go back and calculate the annual contributions that need to be made in order to fund that lump sum. Now, here's this should really resonate with you. Can you just imagine for a minute how large the annual tax deductible contribution would have to be if you use the 3 to 5% assumed rate of return and somebody had a limited number of years to retirement? We've seen people in their 50s, as you'll see an example, put away 4, 5, 6, 7, $800,000 a year, sometimes by putting their spouse on the payroll, if that actuarial calculation works, to get a contribution up to, maybe where they were putting away around 60 grand a year in their typical defined contribution plan to several hundred thousand. So a cash balance plan, okay, which is in our modern qualified plans, you're going to see they're done a certain way. A cash balance plan is a very unique type of tax qualified defined benefit plan that can be combined, with other plans like the 401k and the profit sharing to optimize the benefit for the business owner. The way we look at it, which is really interesting, and the actuary that we work out of the West Coast with on a lot of these plans says it's structured to be a tax control tool and handle the tax situation for a particular client. These modern pension plans, as I said earlier, are markedly different than the old pension plans. We call them, 202, not 101. They're much more flexible in design than the pension plans of the past, and they make them a great tax control tool with a lot of flexibility. So they're very popular these days, and if you understand how they work, they're a niche retirement plan, supplemental to other defined contribution plans. As you know, it's the ability to get a deduction going in and tax deferred growth. They have much higher contribution limits than other plans, creditor protection, as would be seen in other qualified plans. But here's the real key: ease of administration and cost, and a lot of flexibility in design, allowing for a wide range of annual contributions. In the old pension plan, you got to put in X amount of money, and if you didn't put in that X amount of money, you were underfunded, and you had a problem. What's interesting is I'd say we got about a 10-to-1 range, if this is designed right now, in minimum to maximum contributions that an individual could put into the plan. One that we recently did, the maximal contribution was around $400,000, and yet could drop it down to $40,000 without violating any tenets of the plan. So a lot more flexibility than the plans in the past. I want to say a quick word about QBID, or what's called 199A. The Tax Cut and Job Act of 2017, at least this particular tenet of it, we know it's under review with the present administration. But right now, qualified business income deduction still stands, what's known as a 199A. And that allows for owners of pass-through businesses like a sole proprietorship, an S Corp, or a partnership to take a deduction for the lower of either, and there's other tenets to this, but to make it simple for conversation, the lower of 20% of their qualified business income or 50% of their employee compensation. Now, this deduction is phased out subject to certain income restrictions for what they call specified service businesses, such as physicians, attorneys, CPAs, financial services, actuaries, certain consultants, or where the business's principal asset or reputation or skill is really the main, if you will, capital of the business. Here's what's really interesting. Establishing a cash balance defined benefit plan in conjunction with your typical defined contribution plan might allow the specified service business owner to reduce his or her income to a level where they could now qualify for the 199A deduction. And I got to tell you, we did this in our own business. We set up a modern qualified plan, was in 2019, Gene? I think we did. And believe it or not, by doing that, our LLC files as an S Corp. And by setting that up and doing a variety of other tax planning strategies, we were able to get our income down to a level where we were able to qualify for 199A and probably saved ourselves an extra $30,000 or $40,000. It was $44,000 in taxes. So understand, at least until it gets, eliminated, that the use of a modern pension plan might allow your client that nobody thought was a candidate for a 199A deduction to rapidly become a candidate for a 199A deduction. And you're going to find one last slide before then I'll break, and then we'll take any questions, and then Gene will walk you through one of our case examples, is that all our plans, assuming that there's insurability of the participants, include life insurance. Now, you should be happy to hear that, but it's not for our benefit. I think it's win-win, certainly, but it's for the client's benefit, because there is a multitude of advantages of including life insurance in a cash balance plan. And they're enumerated here. First of all, it gives you the opportunity to obtain cash value life insurance, which we all know is a phenomenal asset, with pre-tax dollars. There's not many situations where you can actually deduct the premium on a life insurance policy. It provides for a higher tax deductible contribution limit. You're going to get your limits up even higher when you use insurance in the plan than if you do it without insurance over the life of the plan, since it's technically considered to be funding for both the retirement benefit and an ancillary death benefit. It provides for completion of family survivorship retirement planning in the event of premature death. And here's the really, really fascinating part. It can provide additional tax-free retirement income because at or before retirement, the plan can permit the participant to purchase the policy from the plan for its fair market value, which is usually its cash value, or at retirement or termination of employment, the plan can distribute the policy to the participant. And here's what's really interesting. Outside of the cash balance plan, the insured can access the policy's cash values via tax-free loans and withdrawals to supplement the retirement income, as you well know. So this is one of the few situations where I tell people they can get a tax deduction in all three phases of the money cycle if they play it right, going in, growing in, coming out. So it's pretty interesting.
And the other benefit too is you have the waiver of premium, which allows you to have the life insurance component be self-completed, and Penn Mutual has no. What's interesting is other companies that you can't put a long-term care rider on a qualified plan, but you have it built into your contract. So it exists already with the Penn Mutual product. So not only you protect the person for disability and long-term care, they get the tax-free death benefit. And there's nothing else in our code where you can actually deduct $1 and have your family receive the death benefit income tax-free. You have to pay a small tax for it because it's the one-year term rate, but it's still a tremendous benefit for that person.
So why don't we just stop for a quick
Any
minute if
questions?
there's any questions to this point, and then Gene will run you through an example with some numbers, because numbers, it's good to qualify a conversation, but quantitating it's not a bad idea either.
Okay.
And we'll take questions
So-
again.
Yeah.
within
So
5
one question that came into the chat to me, Fran, is I had one advisor ask, is this a 412I plan that we're talking about here?
That's a totally different plan.
Now, Fran, we can't hear you. Something happened to your speaker. No, we can barely hear you.
How about now?
No, sir. Ed, is it coming through on your end?
No, I'm not. It's all garbled.
Hear us now?
No,
Right in a minute.
We can hear noise, but we can't hear you.
How about now?
no, you're probably going to have to log off and log back on.
I don't know.
Log off, log back in.
Okay.
Wow.
You're out now.
No, still garbled.
Okay.
Shouldn't take but a second. Somebody asked me, we're going to get the slide deck. Yes, I will
Yes.
get the slide deck. I think I've already got it, but can't verify it. But I'll send it to everybody.
And Jeff,
How
when he
about
lost,
now?
we hear you
Yes.
clear now.
All right, let's go back to sharing the screen and, I got to bring that back up. Hold on a minute.
All right, very good. I don't know what happened there, Fran, but the first question was related to, is this a 412I plan? And then
No.
Jeff Cody has also got a question, and I know so Jeff, give us the difference between this and a 412I, if you don't mind.
Sure. Can you hear me now?
We can, clear as a
Yes.
bell.
So this is not a 412I or a 412, it's actually 412E. A 412E is a fully insured, fully guaranteed plan that uses both the fixed annuity and the life insurance, and is relatively restrictive in terms of what you can do. And this is a much more of a traditional split funded plan under the cash balance. So it's not a 412E. You need an actuary to do this plan. An actuary signs off on it each and every year, and it's far more flexible than a 412E plan is.
Hey,
I mean,
Jeff, you had a,
And a 412E plan, I mean, I've done a few in my lifetime. And if I had a single person making a ton of money who wanted a big deduction for the next few years and no employees and understood the lack of flexibility, I might do it, but this is really a much cleaner, simpler way, and it solves for things that come up in life. One of the things that COVID taught all of us is we need to be very flexible as to things that happen in the world. And so I always want to have moving parts and be able to move quickly.
Yeah, there's a lot more flexibility in a modern pension plan than there is in a 412I, especially from a contribution standpoint.
You have another question? I'm sorry. What was the other question, Dwayne?
Jeff, go ahead with yours.
My question is, you can use the sale of other assets, like a business owner, if and when he sells his business, he can use that to buy the policy out of the plan, correct?
You can use any asset you wish, of course,
Okay,
of course.
And that's a biggie. You're absolutely right, Jeff. Sometimes, somewhere down the pike, that's going to happen.
yep,
And a lot of people
And
are
I
also
would-
building wealth, in brokerage accounts sitting outside of the qualified plan.
And I'm going to go over like,
And
we'll go over the different extra strategies for the
Yeah.
insurance.
this is a very elusive topic, so I really appreciate you coming on this morning and doing this.
Cool. Thanks, Jeff. We appreciate that.
So Dwayne, you had a question, D1.
Yeah, it was a really kind of piggyback what Jeff said, or his question. Can you use another type of asset to buy out of a 412I, or does it have to be cash only?
Well, you've got to convert it to cash. Yeah, I mean, theoretically, you're going to buy it out for cash. It's a swap.
In a 412I, but in the cash balance, it can be another asset. Is that right?
No. Cash, and it's always got to be, I'm sorry, the question is, if I'm going to buy this out, and let's pretend I've got 300,000 in cash value, I've got to write a check and buy it for $300,000 out. I've got to swap it out. Yeah, I mean,
Okay.
most actuaries want to see cash buying it out. If you sell your business and you've got cash, if you got money sitting in CDs or treasuries, but you got to buy it out.
Okay. Thank you.
Anything else before we move on? Cool. Well, we'll circle back. We should have time for questions at the end. So why don't you set the stage for,
Yeah, when we do the modern design, there are really multiple parts of it. Obviously the cash balance plan is going to be your single largest contribution. And if the person wants to make additional contributions, we can put in a 401k deferral. We can put in a profit sharing contribution. And we can actually even put in an after-tax contribution like that converts to a Roth right away. We have this on all our sheets. I think it's confusing. We're not going to really talk about that, but it's an option that you can actually do a Roth conversion immediately with an after-tax contribution. So why don't we go through the.
so here, I just want to point out something again. You got this slide deck, and again, we want to try to keep this. This is the first blush. We don't expect you to understand, everything in here. But I do want to point out something that, in this particular case, it was 55-year-old and his wife. And this is an interesting case because talk about falling in good luck, right? I always say I have a ton of luck, but the only problem, it's all bad luck. But if it wasn't for bad luck, I'd have no luck at all. But at any rate, this guy buys and sells companies. And in like December of 2018 or 2019, whatever, like 2 months before COVID hit, this guy bought a PPE equipment business. and he went from like making $300,000-$400,000 a year to making like 2 million. It was absolutely insane. But the beauty about this, if you look down where my pointer is here in this particular case, had the flexibility to go as low as 58,000 and change up to over 450,000. You don't see that in a lot of other plans to have that kind of flexibility to accommodate waxing and waning, in your cash flow in your business. And obviously, it included insurance policies and, we talk about the economic benefits, but is this the slide you want?
Yeah. So I think you can see this board where, can everybody hear me now still? I'm gonna make
Yep,
sure we
yep.
lose you.
You're
Okay,
good.
so in this situation, it was the perfect storm. Like we had the client and we talked to the accountant, we decided to put the spouse on the payroll. It was late in the year. We said, what's reasonable for the last half of the year? And we're gonna put her on the payroll for 50. So you can see we have the compensation of $300,000. And then we begin to walk through what we're able to do. Remember, even though he's making $2 million, we can only use the first 250 or 260 to calculate the formula. We can't use all of that to do that. So you'll see that what's going on here is we're putting away $26,000 each into the 401k plan. We're doing our profit sharing contribution, which is a relatively smaller one, but we can still put away another 18 grand. So we're able to get up to, and then we have the 401k plan totals, which you see are $127,000 total. And then we get into the cash balance plan and we're able to put away $304,000 on their behalf into the 401k plan. I mean, the cash balance plan. So the overall contributions can be up almost above $400,000 for the two of them. And we're able to add back life insurance. And on his life, we put in $1.8 million of life insurance. And on her life, we put up a $500,000 of insurance. So if anyone died early, the plan is more than self-completed. Plus there's waiver premium on both policies. Plus we have the long-term care rider on both of those, or the access to it on those policies.
Yeah, and I'd interject one thing. One of the rules is that there are limitations of what you could put into a profit sharing component. If you have a cash balance plan, you can only go to 6%. So, there's some limitations on funding the profit sharing if you have if you fund your cash balance plan. If you don't, then you have less limitations. But here's a gentleman who's looking for a massive amount of deductions relative to an income that they were going to pay. We got those deductions up pretty considerably relative to just setting up, a typical defined contribution plan.
And to show you the flexibility in this situation, the guy wanted a larger deduction if possible. So the actuary did is said, look, what we're doing here is we're assuming a normal cost of X for the next, 10 years. What we're going to do is we're going to lower the interest assumption for the first 3 because you think because of the nature of your business, you want to maximize the funding. So we got the deduction even higher for him. We put it above 400 grand for the current year. So, I mean, that was the design we could do. Now that will come down in the future years because it's like flypaper. If you take a lower deduction, lower assumption today and returns are better, you're going to reduce future contributions. But he really wanted that because he wanted to get the most money in this in the next 2 to 3 years because he really felt that his business is going to drop down precipitously once COVID goes away.
Yeah, I'd like to point out, we talked about back to who's candidates for this, talk about consultants that don't have any employees. The only employees of this particular structure were the husband and the wife. So they're getting 100% going back into their bucket. And basically, if you look at the tax bracket, we just saved $200,000 in taxes. That's not a bad play.
Yeah, we had a guy at Yale a few years ago who was a dean of a school and he was making about $800,000 a year, but the other agent missed on the fact finder. He had over $30 million of real estate. So I said to him, how did you accumulate $30 million of real estate on an $800,000 salary? That's a great salary, but there's not that much left over after taxes. And he said, well, I have an outside business. And he goes, I make $2 million a year as an international consultant for monopolies. And I said, really? He goes, my wife works in my firm, but I don't pay her. Well, we were able to put away over 600 grand for both of them as a result of just asking that question. And we were able to fund that. And his goal was to fund that and buy the insurance. And he was divorced from his first wife. So he had to keep life insurance in force. So it was beautiful because we got the deduction, got to buy the insurance and the pension plan provided that satisfied the divorce decree and it was all deductible.
And what did the CPA tell us?
Oh, yeah, it was very funny. So the CPA says, you can't do this. It's not legal. I said, yes, it is. He goes, no, it's not. And I asked him, I said, and they said, I don't mean to be offensive, but how long have you been in practice? He said, 5 years. And he'd never seen a pension plan. He'd never been around one. And he was going to squash the whole sale because he didn't understand it. And I had to bring him in the office and show him code and get the actuary on the phone who, I said, this guy goes to the IRS on your behalf. And finally, he was okay with it, but he didn't even understand it. And that just shows you what people don't know, they don't know. I think somebody said that earlier. You don't even know what you don't know.
Can I ask a question?
Sure.
Make sure I understand what's there in the bottom blue bar. So the estimated current tax savings is 189,674. Is that tax that they did not have to pay ever, or is that deferred tax to later years?
Don't have to pay ever.
That's their deduction this
That's their
year.
deduction for the year.
Yeah, when they get to retirement, they have their bucket of money, they'll pay taxes, so they take their money out,
Okay.
whatever that is at that point in time.
Okay.
But yes, the answer is that's their current tax savings. No different than a 401k plan.
Well, 401ks defer tax. They don't
Of
they don't
course,
eliminate
of
tax,
course,
right?
Of course. I
Yeah.
mean, but the goal here is that you're not going to take out, $400,000 as a lump sum all at once, and you're going to plan around the goal. And by the way, it's a very interesting thing. I know Leap and we, Wealth Cornerstones and all the different ones, pay your tax now, go up to the match, but money's funny, it's about volume. And when a person can save 200,000 of current taxes and control it with other strategies in the future, it's very different than saving the deferral on a 401k plan. And it really is knowing your client and know what they want to accomplish. So, one of the questions always and I'd like to give my background was, I was very blessed. I came to work for a person who was one of the forerunners in executive benefits of $1 in the 1960s and 70s, was involved in the first General Electric case. He just was a benefit genius, and also had a full-time pension consulting company, and would go all around incorporating doctors and putting them in defined benefit plans. When doctor, and set them up in C corps, and we did it. I learned the insurance business in terms of the qualified plan business from him, and that kind of changed and morphed. It's kind of ironic that we're kind of back into it. But one of the questions always comes is, like, what does it cost to put insurance inside the plan, and what is the benefit, and why do I want to do that? Obviously, if we take a look at it, we always show the client, here's the plan without insurance, and here's the plan with insurance. And if we take him, for example, and we take the cash balance contribution over the next 10 years of his life, we can see the contribution is $22,000 a year, $222,000 a year to fund his benefit under these actual assumptions. And that's going to go up and down based upon the plan return. If we return more, it will go down. If we return less, it will go up. But that's what's known as his normal cost. And then we have the other side of it, which is with the insurance, and we're going to split fund it, to which 130 is going to go into the investment portion, and 111 for the only 6 years is going to go into the life insurance side. And so you'll see the total contribution. So effectively, he's putting away, $20,000 additional in order, which is deductible, which in order to get this $1.8 million permanent death benefit as an option for his plan. And we're going to buy this policy out so that we can take advantage of the uniqueness. So for $51,000 of an additional tax savings, he's going to pick up $1.8 million of death benefit. So if you take a look at it, and then the actuary we have all the backup sheets, but effectively, if you look at it as a rate of return for his estate, if he died at age 85, he'd have to get 13% on an outside, 12% on an outside investment in order to do this. And the goal is we're going to get to year 6, and we're going to buy this policy out, assuming he has other capital. And once again, you got to know your client. This particular person, if he's putting away, and he's making $2 million a year, and he's putting away 400 into the pension, other money's accumulating elsewhere. He's going to have access to have that as a choice. But one of the questions the accountant's going to ask along the way is, what are my options for getting insurance out of the plan, or how do I handle it? So first and foremost, remember, we have this benefit, and the benefit is if we die early, $1.8 million gets paid to my family income tax free. There's no other way to get qualified plan money to somebody income tax free. The government makes us pay what's known as a 1-year benefit. It's tax code wise, it's called the PS 58 grade, but it really is the 1-year term cost of the underlying insurance company. And it's an incredibly low rate, and you simply pay tax on it, and everybody gets issued as a preferred non-smoker unisex rate. It's just the cheapest rate possible for the cost of that death benefit. So pre-retirement, we have the waiver premium, we have the incredible low cost for insurance, and we also have the long-term care built into the product. When we get to retirement, we have choices. If for whatever reason we decide we don't want the insurance, we can surrender it inside the contract, roll everything over to an IRA. We cannot roll life insurance over to an IRA. It's not allowed in the code. Option number 2 is we can just bonus the policy right out. No different than when you have a corporately owned life insurance policy and you bonus it out to the person. You bonus it out, it's all taxable. You surrender your dividends to pay your tax, and you walk away with a freely paid up policy. You can use it for income purposes, or you could use it for estate planning purposes. You could strip it down and put back, take out, you could decide to take strip it down to zero, buy it out completely for its net reserve, which would be, close to 95% of it would stay within the plan, 5% buy it out. Or you can go to the bank, or you can go to yourself and just simply buy it out free and clear and take it over and then have tax-free income for as long as you live. The clients, we've probably terminated and rolled over 50 policies in my career from the time I started, and the clients buy it out and they have other assets. And, those who don't have other assets just basically either surrender it or they take it out, use the dividends to pay the tax, and they keep the policy as an asset for their estate. But it's a great way to get some extra death benefit from the estate and to get an extra tax deduction in order to buy your insurance.
Yeah, I think what's also interesting about this is, and again, we won't spend a ton of time on it, but we'll answer questions, is if you walk through the math and you talk about ROI, if you really look at it, the difference in contributions, adding the life insurance is really, it costed, after the deduction, about $10,923 a year, theoretically, that if it was used to buy, to take and redirect it instead of buying the insurance in the plan into a brokerage account. And you're going to see where the 610 comes in the next slide, because that's the buyout of the insurance cash values in year 6 or 7. Look at the return that you would have to get on that money invested in a brokerage account in order to equal the income that you're going to get when you take tax-free distributions from the policy between 71 and 90 of $53,000 a year net tax-free. Some tremendous additional leverage. And I think all of us could use more tax-free money during retirement based on the direction the brackets are likely going into the future. So it adds some tremendous value to literally create almost like a tax-free pension plan in conjunction with the components that, to your point, I think, Dwayne, you said earlier, are deferral on taxes that are going to come out, at whatever bracket that's going to be later on the component that was qualified in nature that didn't get bought out of the plan. This is a little smaller, but let me see if I can make this a little bigger. That should be visible.
Yeah, in this situation, we're just showing the person buying it out at the end of year 6 with $610,000. And they're going to buy it out free and clear, and they'll have the policy outside the plan. The 600 grand is sitting in there, will be rolled over to an IRA, and they're going to walk away with all the permanent death benefit, and they'll have a total cash, and you can see the total cash values.
And this is a complex sheet, but
The bottom line is we can take out about $153,000.
I can barely hear you.
Oh, we can take out $153,000 a year in tax. I'm sorry, $53,000 a year tax-free income for as long as we live under this policy, assuming the assumptions are correct. And you can see that in there, plus have the death benefit. So we buy it out, the money's still sitting inside the IRA, and we have $53,000 a year of tax-free income coming in.
So if we
So I
did
got
this, so if we did this for a client, let me start over. If we had a client that this might be a good option for, but let's just say they're not making those millions of dollars a year to be able to be in the position of buying the, swapping an asset for the life insurance at street value. Is this still a good option to consider for them, or is the buyout critical to it working long term?
It's not critical. Once again, for the most part, this is for people whose income is above a certain level. It's got to be, if a person's making $500,000 a year and they're paying taxes and they're left with 300 after taxes, a lot of people are not saving 150 grand a year after taxes. It really, I've really found that most of the time these become very attractive north of 750 as an income level.
Okay.
We've had a few exceptions. So I think number one, it's income level. And then number two, you got to know your client. And it's that person who really does have multiple assets and has, as somebody said very appropriately, has a business they're going to sell down the road and have buckets of money to choose from. It's really tying the whole thing in together. Like you guys use Leap to look at the whole picture. It really is for the right person.
yeah, I'd like to interject something here too, which is interesting. And not that we would recommend this as a primary approach in conversation, But for those individuals, depending on what the borrowing interest rate environment is, believe it or not, the actuary that we work with can run a study on this. And even if the individual didn't have another asset, a brokerage account or the sale, net proceeds of a business sale, to buy this out of the plan at another point, they may very well be able to actually still come out on top by taking a loan, paying the interest on the loan, using the loan to take the policy out, and then use the policy to pay back the interest on the loan and still create a significant income. So there's some plays on that, depending on what the interest rate environment is, actually to borrow the capital if you don't have it there to actually take the policy out,
Okay, thank you.
if that makes sense.
It does. Kind of reverse premium finance.
Exactly.
You got it.
So why not finance it from the beginning?
When you can't finance the insurance inside the qualified plan.
Okay,
Yeah, that's a no-no.
it's very good. Very good.
Is that because it's
If
inside a
if
qualified
it were
plan?
possible, we would. We finance a ton of that stuff.
How can we get in touch with you?
Sure, no problem. I think both Ed and Dwayne have our contact info. I'll give it to you now if you want. I'll be away starting Wednesday for about a week and a half, but I'll monitor my phone. You can call my cell 203-530-4584, or you can email either Gene or I. It's very simple. It's either Fran@strategiclifelines with an S at the end.com, or Gene, Gene, @strategiclifelines.com. And again, I would strongly suggest everybody, take the time to maybe go over, peruse around the website, www.strategiclifelines.com. Maybe if we're fortunate enough to be invited back again, one of the other things is talk about what do you do with those one-time spike income earners where they're not really good candidates for a modern pension plan. But what do you do with somebody that's selling a significant and capitally appreciated asset and trying to eliminate the gain and get a large income tax deduction? That might be a conversation for another day, but there's a very unique charitable strategy that we use that allows for a large income tax deduction, elimination of capital gains, and control of your money. So called the Ideal Plan, which is our proprietary version of a charitable LLC.
Yeah, and the other thing I would do is I would think about, just in my world that I'm in, do I have any clients that as a result of what's going on in the world are going to have crazy good years this year and next year, the next few years? And are there any CPAs or attorneys I know in my world that have access to those kinds of clients? I mean, just to give perspective, we have years where we'll do, 3 or 4 or 5 of these, and we'll do, $300 to $500 of premium from them. It's just a great, home run at the end of the year. The conversations, usually will start. You don't have to make a decision. I know the law changed this year. Usually you have to make a decision and sign all your documents by December and then fund it by the time you file your tax returns. But I tell people the best conversations are in the last quarter of the year. How you doing? How's business? What's going on? Let's talk, who's making a lot of money? Any of your clients, they could save money or, redesign. And a lot of people don't realize. I'll give you one other example. We had a plumbing and heating contractor who had a 401k profit sharing plan. And because he had 25 employees, he did not think he could deduct any more money. Well, it turned out that he really took good care of his employees and was giving everybody a dollar for dollar match for the first 3% and a 5% profit sharing contribution. That qualified for him to be able to carve himself out and put himself in his own plan. And we were able to basically put away $250 for him, and we sold him $2 million of life insurance inside the plan. So because he had an existing plan and was already putting away money, there's different formulas you can use. So sometimes you're shocked at what you can do, even though the census doesn't make a lot of sense.
Yeah, and the other thing I would add to that is, like anything else, and I learned this from Gene many years ago, is that something's got to be doable but meaningful. So, this is not a plan for somebody that's getting 60 grand away per year into a 401k profit sharing plan, but feels that they could probably pump it up to 70 or 75. We're looking for somebody that, wants to go from 60 to 100, probably per minimum, double the contribution. That's 150, 200,000. So it's got to be doable and meaningful, or it's not worth all the hassle.
Very good, very good. Well, Fran, we absolutely appreciate your time today. This has been a fantastic presentation. I know we've had several people with questions, and there'll probably be some more that will come following today's meeting. As Ed has already sent out a copy of the presentation to you in your email, we will follow back up with an email if necessary with Fran's email address and contact information if you didn't catch it when he shared it just a few minutes ago. Guys, we're at the end of our meeting time today. We're officially, the second half of 2021 is technically here.